Tony Robbins, the author of Unshakeable, takes you on a journey to transform your financial life and accelerate your path to financial freedom. No matter your salary, your stage of life, or when you started, the book has enough to help you reach your financial goal. Let's examine some of the key points he makes in this book about achieving financial freedom. Tony Robbins talks about hidden fees. So what are hidden fees involved in common investments? Real expenses accompany every investment, not just the opportunity cost incurred by a decision to forego one item for another. Instead, these expenses and comparisons are not all that unlike from the customers deal with when they purchase a car. Regretfully, a lot of investors overlook important investing charges because fine print and jargon can make them unclear or difficult to understand. They don't have to be, though. Understanding the various cost kinds is the first step. Various investments entail various kinds of expenses. One of the most popular financial tools, mutual funds, for instance, all have what's known as the expense ratio. This is the percentage representation of the fund's management cost. It is computed annually and is based on the total assets invested in the fund. You won't receive a bill for this fee. Instead, it'll be deducted from the return as it is normally paid out of fund assets. In other words, if the fee ratio is 1.5% and the mutual fund earns 8%, your actual return in investment will only be 6.5%. When the expense ratio is large, there's two issues. First, the management team is receiving a larger percentage of your money than you are. Secondly, the difficulty for the fund to match or outperform the market performance increases with the amount of money charged by the management team. Paradoxically, a lot of funds with higher fees say their superior performance justifies their higher costs. However, spending ratios gradually deplete some of the assets, much like a bathtub leak. Tony Robbins wants people to invest in low-cost indexes. So, what are the benefits of investing in low-cost indexes? Using stock indexes and the index funds that track them has benefits and drawbacks. An artificial portfolio of assets that represents a certain segment of the whole market is called an index. A statistical assessment of the stock prices in that portfolio can be obtained from the stock index. Usually, the share of the top businesses in an industry or sector are used to create an index. Charles Dow founded the Dow Jones Industrial Average (DJIA) in 1896, and it was via this index that indices first gained popularity. Following the creation of the Dow Jones Transportation Average, the DJIA was the second stock index. The DJIA developed into an essential instrument for monitoring the health of the overall economy. Since then, the NASDAQ Composite and the S&P 500 stock indices have gained popularity. Bonds and commodities are two other asset groups that are tracked by numerous indices. Stock indexes offer a simple means of monitoring a market's general health. It's simple to assess the present state of the market by focusing on a single statistical measurement. Additionally, investors can get some information from historical data on index movements and prices regarding how the markets have historically responded to particular scenarios. Better decisions can be made by investors as a result. Index funds also have a number of benefits. The primary benefit is that they are passively managed because they only follow stock indices. Because there is no active management, the cost of these index funds are minimal. Oftentimes, index funds are exchange-traded funds, ETFs, and these funds typically have the lowest fees. Because less of the investment profits are lost to fees and charges, this can save investors money over the course of their lifetimes. Index funds do better than active management funds over the long run, according to academic studies. A manager may exhibit a declining performance even if they routinely outperform the market. As a result, many investors find that using index funds in part of their portfolios makes sense. The ability to more consistently meet objectives in relation to benchmarks is another advantage of index funds for investors. Think of an investor, for example, who is prepared to take on greater risks in order to beat the market. Investing 90% in low-cost S&P 500 ETF and 10% in a leveraged ETF with a 2-time S&P 500 will frequently outperform the market. Tony Robbins mentions brokers and fiduciaries. So what's the difference between brokers and fiduciaries? Instead of attempting to handle their portfolios alone in face of the financial chaos brought on by the global epidemic, many investors are seeking expert help. The majority of investors are unaware of the significant distinctions between registered investment advisors, also known as fiduciaries, and big brokerage firms, also known as brokers, such as many well-known Wall Street firms. The primary difference between advisors and brokers is that the former have a fiduciary duty to their clients, while the latter do not. Registered investment advisors are required by the fiduciary standards to always act in their client's best interest. A large portion of what advisors must and should do to fulfill their obligations to clients is motivated by the existence of such a duty. Advisors are required to operate in their customers' best interest at all times, to to prevent conflicts whenever possible and to declare any and all material conflicts when they arise. Brokers are not bound to the higher standard of behavior, despite being subject to some legal regulations. Advisors are required by law to operate in their customers' best interest. As an alternative, brokers are subject to the appropriateness standards, a less stringent regulatory requirement that merely calls on brokers to suggest investments they think the client would find acceptable, albeit this does not always indicate that their suggestions are the best ones. The distinction is crucial. Of course, there are excellent brokers who work in their client's best interest. There are also those in the business who might not have their client's best interest at heart. The fact that the registered investment advisor is required to follow stricter guidelines does not ensure that the advice they give will be sound. Rather, it only means that both the advisor and the firm must use greater caution. Importantly, the fees and charges associated with suggested acceptable investments are structured and disclosed differently by brokers because they do not owe their clients fiduciary duty. Brokers get paid whenever a client engages in a transaction because that's how their fees and commissions are typically determined. Brokers occasionally make recommendations for goods or services that result in higher commissions. Brokers are also limited to selling only certified products on their platform. The great Ray Dalio was interviewed by Tony Robbins. So, how does Ray Dalio invest? Investment risks and opportunities are determined by the economy. Macro investor Ray Dalio looks for possibilities and recognizes risks by analyzing economic patterns. This contrasts with micro investors who place more importance on technical research unique to a given company. Bridgewater received a particular praise for Dalio's macro viewpoint in the 2000s, having studied economics for a long time. Dalio recognized warning signals before the 2008 financial catastrophe. He made recession-proof adjustments to the Bridgewater portfolios, and the move paid off. While the average hedge fund lost 19% in 2008, Bridgewater's Pure Alpha Fund saw growth. Investors are seriously threatened by inflation. Regarding inflation capacity to erode buying power and ruin financial returns, Dalio has a healthy dose of respect. He has long supported the idea of keeping gold as a backup currency. 7.5% of all-weather portfolio, a well-known investment strategy developed by Ray Dalio, is made up of gold. Dalio's go-to portfolio for handling money in lean economic times is the all-weather portfolio. Bridgewater has equities of gold producers and miners in addition to gold funds. With a 1% investment, SPDR Gold Shares, GLD, negative 0.45%, a gold ETF, is Bridgewater's 19th largest holding overall. Uncorrelated assets can be combined by investors to reduce risk. Diversification is something Dalio strongly advocates. To lower the risk-to-return ratio, he suggests diversification over at least 15 different uncorrelated assets. Assets without correlation do not move in tandem, either in a direct or inverse fashion. For instance, there is little link between the S&P 500 and gold. The latter can fall sharply without impacting the former spot price. Portfolio at Bridgewater are diversified in terms of currency, industries, and asset classes. In addition, Dalio has stated that he holds cryptocurrency as a diversification tactic. Profit should be realized by investors in fully priced stocks. Dalio does not only invest in stocks to hold them. He's an advocate of selling pricey stocks at a profit and then reinvesting. This method he refers to as rotating the portfolio. Undervalued stocks or strong companies that are underperforming their industry or the market are suitable targets for reinvestment. Are you an investor in the stock market? What are your thoughts on the book Unshakeable by Tony Robbins? Please share your thoughts in the comment section. For more interesting stories and updates, subscribe to our channel and don't forget to press the bell icon for notifications. Goodbye.